Greetings everyone, I'm Devon Morris, partner at Group 11. I'm going to spend a few minutes taking you through some of the macro numbers in US venture capital and US fintech. Here on this slide, we have US venture capital raised over the past decade. The vertical bars indicate annual venture capital investments in billions, and above it we have the individual year's deal count. The first half of 2021 has almost surpassed 2020's entire year for dollars invested, with $75 billion deployed in each quarter for a total of $150 billion for the first half of 2021. This amount has already passed 2019, 2018, and all years prior. As will be explored further in subsequent slides, in recent years, VC fundraising has shifted towards outside vehicles and target amounts, as VC firms make an effort to raise larger funds in order to support their high-growth companies into later stages. Not surprisingly, many of these same VCs and their late-stage portfolio companies successfully rode out 2020, and now that they see clearer skies in 2021, they are raising even more capital to quickly grow and gain market share. Like the previous graph, the vertical bars here indicate annual US venture capital investments in billions and individual years deal count. But this slide is specifically how many and how much was invested in deals with round sizes of 100 million or more, also known as mega deals. In the US, there were 385 mega deals for the first half of 2020 for a total of $85.8 billion. This represents at least 55% of all US investment dollars in 2021 so far. Like the total VC fundraising, this 2021 year-to-date amount has already surpassed 2020's record for mega deals and capital raised. With only 6 months left, and on the current trajectory, 2021 will likely be a record year for some time. The takeaway from this slide is that more money is going into fewer later stage deals. Not just more capital, but the majority of capital is going to the late stage deals. Continuing the observations and takeaways from the previous slides, we again see that there's more capital going into late stage deals in private markets. But don't be fooled by deal count. Always follow the money. While the left illustration shows the ratio of deal sizes to total number of deals in the year, the amount of capital deployed in 2021 is 90% investments of 50 million or more. Even during 2020 and 2019, at least 80% went into investments of 50 million or more. These two graphs show there's extreme pressure on late-stage deals. We feel this is a reflection of market dynamics and valuation rise. The reality is, investors will get more yield from performing privately held companies than alternative investment opportunities. Many of these companies raising 50 million or more in a single round are rapidly getting market share, and investors want to get in now and buy as much as possible. We will explore performance and yield in later slides. Consider this graph in comparison to the previous slides representing overall US VC activity, mega deal activity, and distribution of round size. The math shows that $1 out of every 5 to 6 in VC investments goes towards fintech. Or alternatively, fintech companies represent 20 to 25% of all US and global funding in 2021. But we're not at the top. This isn't necessarily a peak. The regression line is going exponential. Financial services commands more market cap than any other sector in the world. And in terms of the United States, it's at least 6 to 7% of GDP. If we consider that incumbent financial institutions equate to roughly 16 trillion in market cap, and that fintech market cap globally is sitting at $1 trillion, what it means is that we still have over 90% more room to grow in terms of disruption. Over half of this 16 trillion market cap is owned by Fortune 500 companies that have been around for over half a century. These financial institutions will likely shift and be replaced completely over the next 15 years by fintech pioneers. It will happen, and it's our job at Group 11 to find those fintech pioneers. But don't look at just the funds going into fintech. Look what is happening in all other markets. More capital is going into fintech, which corresponds to rising valuations. Of this graph, 20 to 25% are fintech unicorns, companies with a market cap of $1 billion or more. The visual trajectory of this graph and simulated regression line speaks for itself. Unicorns are being birthed in what is appearing to be an exponential rate. Q2 2021 saw the birth of 136 new global unicorns, with 76 of them in the US, a record high. This is nearly 6 times the 23 unicorns that were born a year ago in Q2 2020, and already more than the 128 unicorns born in all of 2020. The Global Unicorn Club is quickly passing 800 members. This is an astonishing number. As previously stated, in terms of velocity of capital going into fintech and increasing valuations, we believe the current market conditions are another door for growth, not a ceiling for disruption. We wanted to call out some of the biggest fintech deals in the US in the first half of 2021, but there were so many, we had to significantly trim the list just to fit it onto one slide. Notable first half of 2021 deals included global payment processor Stripe's $600 million round valued the company at $96 billion, currently the most valuable privately held fintech in the world. To reinforce my previous illustration, Stripe processes hundreds of billions each year for many of the Fortune 500s and claims that 90% of US adults have bought from companies that use Stripe as a processor. Not Visa or MasterCard or Wells Fargo, but a San Francisco startup that was founded 10 years ago. That is real market growth and fintech disruption. This will happen with Group 11's fintech leaders. There are many other significant US fintech deals, but there's too many to mention here. I'm sure you all read the news. Some of the most exciting items of the 2021 list were a number of Group 11 fintech companies that received significant coverage as they joined the Unicorn Club or moved towards the Decacorn Club. This includes TripAction's Series E that valued the travel and expense management leader at $5 billion, Next Insurance, $250 million Series E, valuing the company at over $4 billion, Sunbit's $130 million Series D, which valued the company at $1.1 billion, Homelight, $100 million Series D, which valued the company at $1.6 billion. Finally, for my section, we continue the format from our presentation in the 2020 Group 11 LP conference call and have included a slide on venture capital performance versus other publicly available indices. We understand your money has other options, so in this illustration, we have shown the rate of return in 1 year, 3, 5, and 10-year horizons of other well-known indices, including the Russell 1000 and 2000, the NASDAQ Composite, the Dow Jones, and the Bloomberg Barclay Capital Government Credit Bond Index. The venture capital index we use here is an industry standard, compiled by Cambridge Associates. Over 2,555 VC funds report their quarterly performance metrics to Cambridge, and they compile and build their own Modified Public Market Equivalent, or MPME, Venture Capital Index. The numbers produced are a rate of return calculation and seek to replicate private investment performance under public market conditions. As can be clearly seen from the slide, the venture capital rate of return is superior to any index for the 3, 5, and 10-year horizons. We believe this slide correlates to the ones previously shared. Investors are finding lower rates of returns through sovereign and corporate bonds, emerging markets, large cap growth, and therefore they're changing after higher yields in early US growth equity and mid-cap stocks. Venture capital and private equity are simply performing better than any other asset. Also note that indices are fundamentally averages. They look at a basket of similar assets and essentially average their total performance. In this table and graph, we are not looking at top quartile or top decile performers in any of the indices. I have given you a lot of information in the past few slides, just as we did in 2020, but I want to reiterate what the numbers have shown. The venture capital is performing over many horizon benchmarks. The pace of fintech investment and market disruption is only accelerating, and we believe that over the next few years, VC and fintech will likely continue to be one of the best performing asset classes. Thank you.